showed up, so it's going to be a bit more tightly squeezed, 5 speakers. And I would say we go with the format, we open the floor for questions after everybody has talked. Okay, we start with Casey Mulligan. Yeah.
All right, thanks for organizing this, and I enjoyed learning things this morning. My piece of this session will be talking about the roads to work and how they relate to public policies. It's a bit of an ambitious talk. I want to talk about the problems of the world, and who carries or who or what carries those problems. And I'll preview the answer. It's the labor market. Now, by what mechanism is the labor market carrying the world's problems? Well, let me give you examples of some of the world's problems. One of them would be absent fathers. We have kids who are born and their fathers don't take care of them financially. Of course, we should make them pay. And then what we end up seeing is that they're under a whole lot of debt. And they start to realize, hey, if I go get a job, the government's going to get all my money. So maybe I won't go get a job. Another kind of debt, housing debt. When the house is underwater or the mortgage is not fully secured, again, what do? Just like with the fathers, economically it's just like the fathers, maybe morally it's different, but what we do is we say, well, the people who are going to have to pay more for their house will be the ones who are able to pay, the ones who are employed or have more income. And the people who will get a break on their mortgage will be those who make less or aren't working. Rising healthcare costs, similar sort of deal. Who's going to have to pay for health care? People with jobs, people with more income. Go to my own employer. I don't speak for my employer, but I acknowledge that I am in the education industry. What do? We charge more to the parents who have more money and charge less to the parents for the same diploma, the same classroom experience who have less money. And the more that the cost of education goes up, the more we do that. And I could go on and on and on with all kinds of unfairness that we have in the world, and the way we deal with the unfairness is by linking up who pays with their income and their employment status. So, you know, what's holding the cart to the ox here, the labor market ox? It's employment and income taxes. Now, you know, you say it that way, and it seems like, well, I'm afraid that's how the world works. We live in an imperfect world, and that's how it works. But then when I see people talking about the labor markets, they don't talk about these issues at all. I mean, it's completely absent. Here's an example from the Chicago Booth, University of Chicago Booth panel of experts talking about the labor market and the stimulus. They don't mention at all what the stimulus does around incentives to work, employment, and income taxes. They don't even mention it. When Federal Reserve, another panel of economists asked to name the most important reasons why jobs haven't returned. They don't even, none even mentions this stuff. Federal Reserve presidents, the one who was here, talked about this and talked about the issue of the labor market, doesn't mention marginal tax rates and incentives and taxes on work and stuff like that. And I don't want to pick on Minnesota Fed president, pick on the Chicago Fed president if you want. It's a normal way of talking about these issues. Now, one reason why, maybe where they're coming from, to speculate a little bit, is if you look at taxes narrowly defined, and it's not hard to narrowly define it this way because April 15th was very close, right? This is to talk about the personal income tax, the Form 1040. And what I've done here, I use the NBR has done nice work over the years calculating. Of course, every household has a different marginal tax rate on Form 1040, but what they've done is calculated an average of all the households in America, what's their average marginal tax rate. And you see very little change because during this period of time, the federal law hardly changed, and what you had is a handful of states who made some changes, and so you see little wiggles. Look at my scale there. Each tick is 2 points, so the wiggles are tenths of points. So it seems like taxes didn't change, so if something's not changing, why talk about it when you're talking about change? I could see that. But here's the next picture. This is, again, each tick is 2 points. I had to adjust the scale because I'm adding in more taxes, so the level is higher, but the changes mean the same on both red and black. And we had an awful lot of changes in the last 10 years in the average incentive to work And one thing I want to emphasize here, I'm not focusing on low-income people. I'm going to focus on middle-income people because most people are middle-income in people, and from an aggregate perspective, you certainly want to count them. The other thing that I'm doing here is I'm only look at when the law changes. Just the same that NBR does. The red line can only go up when there's a new law about how benefits are calculated or people are included in the program. If the law stays the same, then the red line stays flat. The third thing I want to point out is what the red line, I think it's the red line, it's the right thing to look at, includes implicit taxes. So whereas the black one is taxes, as a politician might call it, the economist recognizes that no, there are implicit taxes. It's not that much different to say, hey, when you earn more, you have to give more to the IRS, versus when you earn more, the IRS is going to pay you less, or some other agency is going to pay you less. They're very, very similar. And those are included. The other thing that's included here, which is a big, big deal, is not just the income tax, but employment tax. Two things kind of happened at the same time, so I put them on here separately so you can see what's going on. The last part of the stimulus ended. That's the EUC program. It wasn't a trivial part of the stimulus, but it ended at the same time that Obamacare started, or the Affordable Care Act. Depending on which side you're coming from, you use different words for the same law. And they kind of cancel each other. So it's a little bit hard to see all the action. But what ended up as a temporary program ended up being kind of permanent because it was replaced by the ACA in a broad perspective. And the important thing, I think, here is the secular trend. We were talking about at lunch how we're different from Europe. Well, we're less and less different. We're becoming more and more like Europe in terms of the propensity to tax work. This is a table showing the different statutes and regulations that changed and created jumps in that red line at different points in time. The columns are organized by employment tax versus income tax, and notice there's an awful lot in the employment tax column as opposed to the income tax column, which isn't trivial. But maybe more important is the italics are the explicit taxes. And I'm not getting into the Supreme Court thing. It's like, is a penalty a tax or not? I call those both taxes, okay? But still, they only get 2 entries. All the other entries are implicit taxes. And that's another way of saying, boy, that red line, which is more inclusive, is very different than the black line, which is about explicit taxes. Now, employment and income taxes, why do people look at income taxes? They do look at them in the context of work, is because a very, very big reason why people work is to get income. And so you say, well, you tax income, you're taking away some of their reason to work. And I'm all for that. I'm not against it. But the other thing is that people leave out is employment tax. This is a tax on having a job aside from how rich or poor you are. And you would think an employment tax would affect employment just as much or maybe more than an income tax would, because it's taxing the actual act of being employed. And this isn't just an academic distinction. A lot of the stuff that's been going on in the last 10 years are employment taxes. The premium tax credits on the Affordable Care Act, they have an income tax part that you're probably aware of and everybody talks about. They also have an employment tax part. There's a part of it that's solely tied to your job and not how much you make. The cost-sharing subsidies, similar story. The employer penalty, again, tied to having a position on the payroll, regardless of whether that person on the payroll is from a rich family or a poor family, $2,000 or $3,000 ahead. Unemployment assistance, again, is not based on whether you're from a rich or poor family. It's based on whether you're in the job or not. When you're in the job, bye-bye to that assistance. That makes it an employment tax. This is a typical graph, and I like these kind of graphs, and we should look at them, but I want to point out what's missing. This is a typical kind of graph that you see where they say, okay, let's look at what a household might earn in a year and think about the amount of benefits that they'll get paid at those different income points. And I'm sure you've seen these sort of pictures before, and they have the different programs in there. My point here is they don't have employment taxes in here because it's not based on the income, so they leave it out. But it's not, we can't leave it out if we want to do a careful analysis of employment. We can't leave out employment tax. So the UI benefits aren't in here. The employer penalty is not in here. And a very important part of the exchange subsidies is not in here. The employment tax part of it is not in here. You just have the income tax part of it. So we're not getting the full picture. Another point I heard discussed this morning and at lunch is like they pointed to the DI program. They say, hey, the DI program's not that big a deal in terms of aggregate employment, which I agree with. Okay, but what I don't agree with is making the fallacy of the heap. The fallacy of heap says that's a small thing. Therefore, I can approximate it as 0, and then I can multiply that small thing, which is 0, by any number I want, like 20, and I still get 0. And we have, as I showed you, we had lots and lots of programs coming in, and I don't care if a study shows me that any one of them had a small effect. I'm interested in the total effect. And you can't just say, well, each one showed me that it was negligible, therefore I can neglect the aggregate. That's the fallacy of the heap. Moreover, this like gives the mathematical logicians credit. We economists understand that the costs of these sort of things are convex. So it's even worse than the fallacy of the heap. We can't assume that a bunch of small things add up to something that's negligible. And that's a reason why I built that series, the red series, that brings in as many taxes as I could work on over a 2 or 3 year period. And so I'm back to this picture, and that's why it's important to say that we got the problems of the world, and any one of them might not seem that big, but when you start adding them on top of each other, don't be surprised when this ox has trouble pulling the cart. Okay, I'm going to look at, I showed you that the taxes were there, on the books, in the laws, in the agencies. Are they having an effect? Were they having an effect? I'm going to start out, I'm kind of old school, start out with aggregate time series. I understand it's totally unfashionable to do that, so I'm going to be brief. We'll start out with that. One thing, when the Stimulus Recovery Act, whatever you want to call it, ended, we saw an increase, just a coincidence I'm sure, an increase, we started to see a recovery in the labor market. Here I'm measuring the amount of work done on a per capita basis. When did that recovery start to slow down? Again, just a coincidence, exactly when the employer penalty started in part. The employer penalty came in kind of 2 phases. And when did things slow down again? Exactly when the employer penalty came on full force. Time series evidence, we ignore it, got it. We'll move to the next slide. This is what I did is I distinguish all the workers both in terms of the skills they have, education, experience, and stuff like that, and in their marital status. Now, usually when we do labor, we don't distinguish by marital status. But coming from the tax side, I do distinguish by marital status because these different programs that we've talked about, food stamps and Medicaid and so on, are very different on the incentives of a married household versus an unmarried household. So I made that breakdown and I asked, okay, that red line where a statute changed somebody's incentives, let's calculate that incentive change for each of these 10 groups. And then let's look at their behavioral change for each of the 10 groups. So that's the horizontal axis and the vertical axis. And gee, they kind of line up. And one of the things nobody's talked about until I got into this is, boy, look at the difference between married and unmarried. The unmarried had a much deeper recession. Why is that? I mean, unmarried is rarely used in labor market analysis, so it doesn't seem intrinsically mattering. My explanation is, yeah, well, the unmarried had a lot bigger change in the disincentives that came on with new programs. Another explanation, I guess, would be you should just rent a wedding ring when you go to the job interview so they give you the job. But I'll go with the public finance explanation every day. Another comparison I made, since we're doing comparisons among different groups, United States and United Kingdom. I've been over the UK. They speak this funny accent. It's hard to understand. So we say stimulus, and that means like food stamps, healthcare expansion, unemployment. That's what we mean when we say stimulus. They say this word that sounds like stimulus to me, but in the UK what it meant was cutting the income tax rate, cutting the sales tax rate, increasing the reward to work, while our stimulus, sounds the same, was decreasing the reward to work. Here's, it depends, like all these things, it depends on whether you're a high-skilled worker or a low-skilled worker and where you sit in the family type assistance programs. They're called credits over there. So I've shown you all 4 groups. And this is the opposite of tax. This is an incentive. So when it goes up, it means people get a bigger reward to work. When it goes down, they get a lesser reward. And what you saw, during the crisis and the year or two after the crisis is the incentive to work went up in the United Kingdom because of their stimulus. They cut income tax rates and they cut the sales tax rates. And then for the bulk of the people, it kind of came back. There were some groups who ended up below. Now, what happened to the labor market there? Well, the recession, I know this is just coincidence, so, but we might as well just look at the data since we have it. In the United Kingdom, the recession wasn't as deep, and they got to full recovery in terms of getting labor per capita back to 100. They got it back a lot quicker. We're still not there, and I'm not sure if we will get there before my retirement. And I think the public finance view, I think, explains this pretty well. So if you, we're jumping to the video. I was going to give my own personal version, but while it's coming up, I'll say, if you asked me 11 years ago, not 10, but if you asked me 11 years ago, can federal policies like these have a visible effect on the labor market? I'd say, I don't know. It seems a little hard for it to all add up. Well, President Obama kind of agrees with me, and that's the video I wanted to show. If we can hear him.
Of course he agrees. That you no longer hold today, that you flipped on. You've changed on because you actually see it differently.
Because I actually changed my mind.
You changed your mind, exactly.
Well, you know, I'm trying to think back 10 years ago. I think that a good example would be the issue of welfare reform, where I always believed that welfare had to be changed. I was much more concerned 10 years ago when President Clinton initially signed the bill that this could have disastrous results.
So President Obama has underestimated the power of incentives. I've underestimated the power of incentive, I will confess. But we don't need to make the same mistake over and over again. So I'm glad that we're able to give some attention to incentives and pay attention to that and understand that we may reap what we sow in that area. Thank you.
Okay, thank you very much. Yeah. Next speaker is Derek.
Yeah. Apparently, President Barack Obama had some neoliberal ideas as well that might not be actual. All right, so let me get into this and say, I'm about to present a bold idea that William Darity has led, and I have worked with him on, and we've also included various co-authors throughout the years. That would be Alan Aha, Daniel Bustillo, Mark Paul, Kai Zha, Afranima Bial. And then I also want to give a shout out to Policy Link for embracing this idea and helping us develop it even further, and in particular, Angela Glover-Blackwell and Sarah Truhaft. The private sector has never adequately dealt with reinforcing inequalities, worker vulnerabilities, and obstacles to social mobility. Even in times of economic expansion, there are never enough jobs for job seekers. Moreover, far too often, those that have a job lack a quality job. So we've talked a lot about jobs, but not a lot about quality of jobs. For instance, 44% of the homeless have a job, unfortunately with wages not adequate to elevate themselves out of homelessness. 40% of workers have contingent insecure employment, and almost half, 44% of workers, earn below $15 an hour. Over the past 45 years, basically all of the economic gains from productivity have gone to the elite, while worker real wages have remained roughly flat. We propose the permanent establishment of a federal job guarantee to eliminate working poverty altogether, as well as eliminate involuntary unemployment altogether. But we also want to propose the policy to provide an authentic public option of employment that enables existing workers to bargain for better wages and working conditions. Momentum is building for this idea. Senator Cory Booker released a co-sponsored bill with Senators Gillibrand, Merkley, Warren, and Kamala Harris to establish a pilot program to provide grants for a job guarantee program. Senator Bernie Sanders has gone even further. His office is close to the release of a bold, transformative, full-scale federal job guarantee. The idea of a federal job guarantee is not new, nor is it radical. President Roosevelt's State of the Union address in 1944 introduced what he called the Economic Bill of Rights. Roosevelt's belief was that the American Revolution was incomplete, that a new set of rights were needed, economic rights. The first article of his proposed second Bill of Rights was the right to employment. Roosevelt called for, quote, physical security, economic security, social security, and moral security as a universal right. Before Roosevelt, there was Huey Long's 1934 Share Our Wealth Plan, in which he declared that the United States should use public works to ensure that everybody is employed, and subsequent to Roosevelt, Reverend Martin Luther King Jr. demanded the immediate employment of everyone in need of a job. Recent polling data reveals robust majority American support for a job guarantee, while less than 1/3 of Americans voice opposition. The majority holds across all 50 states, so this is useful for those thinking about electoral politics, and across all racial groups, even when it's presented as an idea from the Democratic Party and an idea in which we would have to raise taxes on the rich to pay for it. And as reported by The Nation magazine, the support for a job guarantee from blacks and Latinos is, quote, through the roof. Persistent and embedded joblessness is particularly pronounced for blacks, Latinos, the disabled, recent military veterans, non-college educated adults, women, and the previously unemployed, all of whom are stigmatized in our workplace. We'd be remiss to discuss labor market disparity without mention of mass incarceration. Black males make up about 6% of the US population, but roughly half of the approximate 1.5 million inmates in state and federal prisons. There's about a 1 in 3 chance that a black man will end up serving time at some point in his life. These incarcerated individuals are characterized by Becky Pettit as invisible men because they are excluded altogether from our employment calculus, and upon release from prison, their employment prospects are bleak, especially when we intersect it with race. In spite of these enormous disparities, the political presumption is that if a greater share of blacks and Latinos invested more in a good education, which in turn would result in better jobs and higher income, then disparity would dramatically reduce or be eliminated altogether. However, education is far from a cure-all that it's purported to be. Over the past 45 years, regardless of comparable educational attainment, the black unemployment rate has remained roughly twice as high as the white rate. Ultimately, incorrectly framing the central problem of inequality and racial disparity as deficiencies internal to the poor and blacks themselves leads to a policy focus on rehabilitation of the family, particularly the black family, which Dr. Mulligan has referenced a little bit in his talk. Herein lies the rationale for austerity policies. If behavioral modification is the central issue, why fund government agencies and programs which at best misallocate resources to irresponsible individuals and at worst create dependencies that further fuel these irresponsible behaviors? As a result, we end up with laissez-faire austerity or supply-side interventions like President Barack Obama's My Brother's Keepers program, which is paternalistic in the fact that it totally ignores the plight of black women altogether, and it attempts to leverage, it's paternalistic and it totally ignores the plight of black women altogether by attempts to leverage private and charitable resources to prod so-called defective black males to become more employable rather than addressing the discriminatory labor market conditions that they face in the first place. The emphasis on individual behavior as opposed to structures follows from a perspective where the free market, as long as individuals are properly incentivized, is supposed to be the solution to all our problems, economic or otherwise. Markets, whether they're product markets, financial markets, or labor markets, are presumed to be self-regulating. The most astute, the most valued, the hardest workers are believed to prosper and endure, while the least astute, the least valued, and the laziest are presumed to receive their just rewards and simply fade away or have to do something else over time. These presumptions pay little attention to the roles of power and capital and how that power and capital can adjust and alter the rules and the structures of transactions that to privilege power and capital in the first place. Stigmatization based on race provides the political fodder to implement harsh and punitive controls on the underclass. Because of their marginalized social status and overrepresentation in poverty, blacks become the ideal symbolism by which this surplus population, characterized as persistently unemployed and unemployable, a source of urban crime and malice, and whose subsistent needs is a drain on fiscal budget, becomes defined. As a result, the state uses incentives and sanctions to coerce or discipline the underclass, not working to eliminate poverty, but rather to manage seemingly bad behavior with increasingly punitive tactics. The local implementation of the fight for 15 minimum wage is indicative of an offensive strategy, but it's not nearly bold enough. It still leaves many workers unemployed or out of the workforce together. A conservative response to the minimum wage has been the true minimum wage is actually zero for those that are unemployed, and to a large extent, they were correct. The minimum wage does not address the volatility of work hours and unemployment duration associated with increasingly precarious labor economy, nor does it address our 21st century physical and human capital infrastructure needs, or how increasing vulnerabilities to natural disasters resulting from an unnatural climate change all require substantial public investments. The Trump administration's job and infrastructure plan, as well as similar plans championed by some on both sides of the political aisle, use tax incentives and deregulation to cajole or bribe the already record profit-earning private sector to provide more jobs and rebuild the nation's crumbling infrastructure. This approach leaves workers vulnerable to the fickle contingency of trickle-down employment and the instability of contingent work. It also diverts public resources away from public assets towards producing profits for private firms with no guarantee that the infrastructure will be built in the first place. Related are stimulus and job creation programs that offer time-limited assurances of public subsidized jobs that may be administered through either the for-profit or nonprofit sector after a worker has demonstrated some waiting period of unemployment. Sometimes it's 90 days. These plans are not transformative. They do little to enhance the bargaining power of those already employed. The benefits of these programs don't go into effect until the worker is actually confronted with unemployment and poverty. In contrast, the federal job guarantee that we argue for is structured to keep workers employed and out of poverty in the first place. These job creation programs are designed to complement rather than compete with the private sector. As a result, the programs end up subsidizing low-wage work, while in contrast, the federal job guarantee would raise the floor on wages and benefits and working conditions by providing workers a viable, competitive alternative to precarious work. Also, job creation programs that administer jobs by way of subsidy to nonprofits raise partisan political concerns regarding which nonprofits can and cannot receive funding. Also, they present the opportunity to usurp or misappropriate the mission of nonprofits by way of coercion with political funds for political purpose. This is somewhat akin to the CETA programs originally funded under Nixon's employer of last resort programs. CETA has been accused of misdirecting particularly black political organizations that serve the black community into less potent community organizations that serve the black community under the coercion of federal government. One might wonder if we had a federal job guarantee that was administered through the nonprofit sector, you could imagine organizations like, for instance, Planned Parenthood being subject to volatility based on which administration is in office. You can also imagine organizations like the NRA being empowered to provide jobs in school for security, et cetera, depending on which party was in power. So perhaps we don't want those partisan concerns in the program. Also, job creation programs that rely on matched state funding will have detrimental racial and class implications, since blacks and low-income Americans are overrepresented in states that collect less tax revenue and are more hostile to public programs. In contrast, the federal job guarantee, which is not reliant on state funds, prioritizes areas with the greatest employment needs as well as areas with the greatest human and physical infrastructure needs. The federal job guarantee could provide regional and state balance, as well as budgetary relief for state and locality budgets when there's an economic downturn. Also, the job creation programs with eligibility and termination requirements are susceptible to stigmatizing workers and to discrimination in their implementation. In contrast, the federal job guarantee moves away from a disciplining the poor frame to instead an economic rights frame, which serves to alleviate racial and gender stigma and discrimination in general. Ultimately, the left's promotion of job creation programs in the context of a growing momentum of the federal job guarantee provides the potential for another example of a progressive idea being co-opted, watered down, or deviated from its intended goal. Why be self-defeating? Why introduce the compromised position before the transformative position has actually a chance to become fruition? Our plan for a federal job guarantee administered by the permanent establishment of the National Investment Employment Corps would provide a direct source of employment and enable all workers, particularly those at the low end of the labor market, to bargain for better wages and better benefits without the fear and destitution from the threat of unemployment. It is not an employer of last resort program, but a viable alternative to undesirable, low pay, low benefits, and poor working conditions. It would structurally change the U.S. economy away from low-wage work towards more moderate and high-wage work, in which our expanding global economy when the U.S. is becoming increasingly less competitive, towards more moderate and high-wage jobs. Moreover, it would provide the best buffer against employment transitions due to either automation or due to technical change in general. What we have in mind is more extensive than local job training or search assistance programs, which do not ensure employment. Many skill building and workforce development initiatives leave intact structural barriers to employment. The apprentice and on-the-job training programs that we envision with a federal job guarantee would come with the assurance of a productive job at a decent wage when you finish. To be clear, we are not talking about welfare to work or workfare, which impose work requirements as a mechanism to discipline the poor. Rather, we're talking about empowering workers with an authentic right to work for decent wages on a productive job that enhances our nation's public, physical, and human infrastructure. If at the current relatively low unemployment rate of 3.9%, there are still 6 million workers who remain unemployed, an additional 5 million who are working part-time, not by choice, but due to economic reasons. Furthermore, the number of job seekers continues to substantially exceed the number of job openings. More generally, last year there were 43 million Americans who lived in poverty. Having Americans out of work does immense damage to our human spirit, and it imposes extensive costs on individuals, families, communities, and society as a whole. Our transformative policy would eliminate persistent involuntary unemployment, ensuring that the United States lives up to the unfunded mandate to achieve and maintain full employment outlined by the 1978 Humphreys-Hawkins Full Employment and Balanced Growth Law. The federal government, states, Indian nations, local municipalities would have to conduct inventories of their needs and develop a job bank of tasks to be performed. Priority would be given to the most urgent projects to aid the most distressed communities. The work done would address the nation's 21st century infrastructure needs. The jobs could range from construction, education, and health service, supportive housing, libraries, child and elder care, arts and culture, projects designed to transform our cities to green, emission-free municipalities that are more sustainable as well as resilient, provisions for human infrastructure investment would include high-quality universal kindergarten education, pre-K, child care, adult care, elder care. Some of the care provider could even be trained to deliver special needs. The current exorbitant cost of child care is a major obstacle for many parents, restricting their access to the labor market and greatly exacerbating inequality in both access and opportunity for children. While our proposal is facially gender neutral, it is gender conscious, since basic elements could disproportionately benefit women who disproportionately carry our nation's care obligations. We could include disability-centered advocacy to facilitate more long-term solutions towards dignified employment, livability, and financial independence. Similar programs could be designed to emphasize transition to employment for formerly incarcerated individuals. A federal job guarantee would constitute a direct mechanism of job creation and trigger a multiplier stimulus effect across a panoply of activities that take place in our economy. It would address both cyclical and structural unemployment. With respect to the former, the National Investment Employment Corps would function as an automatic stabilizer, putting more people to work in economic downturns and fewer in economic upturns. The minimum annual full-time entry wage would be $25,000. The average wage would be set at $32,500. So basically, there's gradation in wages and opportunity for promotion in the program. And another $10,000 would be dedicated towards fringe benefits. We estimate the cost of a job would be about $55,000 per job. Given our current unemployment scenario, a conservative estimate of the total cost of the program would be between $600 and $650 billion, and there's no dynamic scoring with regards to cost savings. So full-time workers would receive medical coverage, retirement support, paid family and sick leave, and up to 8 hours per month for workers to engage in professional development and pursue other employment opportunities. Correspondingly, the net expenses of the job program would be reduced by a wide array of cost savings from other social programs that could be either reduced or eliminated altogether. Furthermore, the income paid to employees of the National Investment Employment Corps would restore tax bases at the state and municipal levels, alleviating current budget crises. The medical coverage of a job guarantee would basically provide an implicit public option, leading to coverages of millions of uninsured Americans. The need for market interventions like a minimum wage could be strongly curtailed, since the floor in the private sector would set a wage standard for all jobs. The moral hazard problem, this is useful for the Fed, associated with the implicit promise of bailout of the financial sector in times of crisis would be dramatically curtailed. Basically, a federal job guarantee would buffer the economic well-being of Main Street from the risky so-called too-big-to-fail Wall Street firms. In addition, a federal job guarantee program would mitigate personal and familial costs of damaged mental health and other stressors faced by the unemployed. The unemployed themselves often say that they would rather be paid to work rather than receive unemployment compensation. Dignity is multifaceted. One's dignity is not limited by work, but everyone should have a right to work with the dignity of at least decent wages, benefits, and working conditions. Not only would a federal job guarantee restore balance and not only would a federal job guarantee restore psychological balance to the millions of unemployed individuals who desire to work but cannot, it would also address our long-standing, unjust, and discriminatory barriers that keep large segments of stigmatized workers out of the labor force and reverse the rising tide of inequality for all workers by strengthening their labor market bargaining power and eliminating the threat of unemployment altogether. Thank you.
We continue with William Darity.
And I'm not actually any taller than Kathy Abraham, but I will speak from here. I'm going to cheat a little bit on the title of this session. I'm going to translate the future of work into a discussion of the future of opportunity or the future of social mobility. maybe the future of equity. Since I'm a science fiction and speculative fiction buff, maybe collapse it simply to the future, a desired future. My impulses are more utopian than dystopian. Derek and I have incorporated the federal job guarantee into a policy agenda that we call an economic bill of rights for the 21st century. As Derek noted, we are inspired in part by Franklin Roosevelt's economic or second Bill of Rights presented in his 1944 State of the Union address. We interpret the first two planks of Roosevelt's original list of 6 items, which we have adopted in full since they have yet to be entirely fulfilled, as a right to decent employment. Derek's presentation on the federal job guarantee describes a policy we think can make the right to decent employment a reality. The remaining 4 items on Roosevelt's list were the following. Third, a decent home. Fourth, adequate medical care and the opportunity to achieve and enjoy good health. Fifth, the right to adequate protection from the economic fears of old age, sickness, accident, and unemployment. And then sixth, the right to a good education, which, perhaps surprisingly, never has been a constitutional provision in the United States. We have made 3 additions to the list. 7th, the right to sound banking and finance. 8th, the right to a safe and clean environment. And 9th, the right to a meaningful endowment of resources as a birthright. It is the latter that's going to be the subject of my remarks today, given my desire to propel us toward a more utopian future. This particular right, the right to a meaningful endowment of resources as a birthright, puts the spotlight on wealth, which is foundational for life chances in America. Last year, I think I indicated at this convening that wealth is more important than income in shaping opportunity in America. The response I received is, well, that can't be the case because people generally have so little of it. That, in a strong sense, is precisely why wealth is more important, since wealth provides insurance against declines in income, particularly unexpected declines. The labor market is not the site that we should emphasize to understand economic inequality. The site we should emphasize is the processes of stratification that lead to sharp wealth differentials. Moreover, although it is far less evenly distributed than income, and despite the fact that the top 1% of American wealth holders possess more than 40% of it, in both an absolute and comparative sense, it's really blacks and Latinos who have very little of it. Depending upon the data set we use, we get estimates at the median that black and Latino households have anywhere from 5 to 10 cents per dollar of net worth possessed by white households. I'm going to focus on black wealth for the purposes of the conversation today, or the absence of it. In a study released last month, produced collaboratively by the Cook Center and the Insight Center for Community Economic Development, called What We Get Wrong About Closing the Racial Wealth Gap, we reported that the median white household in the lowest quintile of the income distribution has about $18,000 in net worth. Black households in the lowest quintile have a median net worth of approximately 0. But moreover, the lowest income white households have a net worth that exceeds the median net worth for all black households. At the other end of the wealth spectrum, black households are fewer than 2% of all of those in the top 1% of wealth holders. White households constitute more than 96% of the nation's topmost wealth holders. The 99th percentile black household is worth about $1.6 million. The 99th percentile of white households is worth $12 million. Out of a total of 20 million black households, fewer than 380,000 have a net worth of $1 million or more. Out of 85 million white households, 13 million have a net worth of at least $1 million. Blacks with a college degree have less wealth than whites who never finished high school. Blacks working full-time have less wealth than whites who are unemployed. These enormous wealth differences readily explain the recent Chetty et al. Finding that black males have greater downward mobility if they are in more affluent families or comparatively more affluent families than white males from similarly situated families. Now, the sources of these disparities weigh heavily on intergenerational transfers of resources and opportunity. Pfeffer and Killewald have a recent study in which they demonstrate that there's a strong relationship between the previous two generations' net worth position and that of the third generation. And indeed, they find that there's actually a greater correlation with grandparents' wealth than parents' wealth. This connection is executed not exclusively through inheritances, which is what we typically think of, but also through in vivo transfers, transfers that occur while the donors are still living. Wealth also minimizes economic anxiety. Indeed, the loss of a job for a wealthier household may make it possible for them to maintain their income level for multiple months or perhaps multiple years, which is a vastly different situation from those households who cannot maintain it for a month. Indeed, wealthier households can select homes or residential locations that ensure that their kids have quality schools and safer neighborhoods. But what about the specifics of the origins of the racial wealth gap? Here we find factors that significantly lower the resources black grandparents and parents have to transfer to their grandkids or their children. I want to highlight 4 occurrences that are associated with the huge racial wealth disparities that we currently observe. The first of these is, at the start, is the denial of 40 acres and a mule, which was promised to the ex-slaves at the end of the Civil War. The denial of those resources has had long-term repercussions in terms of perpetuating the deprived wealth status of black Americans. The second is the property destruction and seizure that took place over the course of the long Jim Crow period. We are now at the point of the 50th anniversary of the Kerner Commission report, a report on urban uprisings in black communities that took place in the 1960s. But Derek and I are co-authors on a paper prepared for the Russell Sage Foundation's journal, where they have a special issue on the Kerner report, where we argue that there was no comparable report ever conducted on the long list of white massacres which took place up until the 1950s that destroyed black lives and property on an extensive basis throughout the United States. The most extreme examples are probably Wilmington, North Carolina in 1899 and Tulsa, Oklahoma in 1921. But there's a host of others with extreme levels of destruction of both black property and lives. The third thing is the lynching trail in the United States, which we frequently don't recognize was a trail that was also associated with the appropriation and seizure of black property. So for example, in 1892 in Memphis, Tennessee, a store owned by successful black businessmen a successful black businessman competed with a nearby white-owned shop. This particular owner and 2 of his employees were lynched and the business destroyed. In 1947, many years later, Elmore Bowling in Alabama was shot to death by a white neighbor. Bowling had built several successful businesses and had more money than many whites in the community. But I'd also like to emphasize a report from Melissa Fussel's article in the William and Mary Law Review in 2016, where she talks about the example of a gentleman named Jewel Perry, who was hanged on Election Day 1920 in Ocoee, Florida. He had tried to vote, and most people think that that's the reason why he was lynched. But there are some members of the black community that whispered that he and his family were targeted because of their wealth. And after 1920, 500 black residents of Ocoee disappeared, including 100 of them who had owned their own land or property. Black residents were told they could leave or die under the threat of mob violence. Fussell reports, a committee of white Ocoee residents, together with the local court, distributed black residents' property to white citizens in the aftermath. The victims were uncompensated for the most part, although some received a few dollars. Congress endorsed the actions of the Ocoee government and white citizens after the fact, commending them for upholding law and order. So the phrase law and order has had a particular resonance for quite a while in the United States. In addition, I'd like to mention the racialized character of mid-20th century social mobility policies, the most dramatic of which was probably the GI Bill and the various programs for subsidizing home ownership. These were heavily racialized, so there was a sharply disproportionate benefit of these programs that was given to white Americans. And in addition, this was compounded by the existence of redlining practices. And the final thing I'd like to mention in this context are wealth stripping practices, like the contract buying schemes, the pressure to rely on predatory lending because of the reduced access to more conventional forms of credit, and the rise of for-profit universities as a mechanism for creating high levels of indebtedness on the part of black students. So what's the solution? The solution is a program of reparations targeted at eliminating the racial wealth gap. The median differential in black and white wealth, if it was to be closed, would require an expenditure of approximately $2 trillion. But if you were going to close the entire racial wealth gap, then you would have to look at the mean differential, and that would require an expenditure of close to $18 trillion. And this is apart from the question of compensating for the effects of the gap that has existed for such a long period of time in the United States. Indeed, the persistent racial wealth gap is the most potent indicator of the cumulative effects of white supremacy. I recommend the introduction of a portfolio of reparations. So there would be resources that were direct payments to individuals. Let's call it the check that everyone always talks about. But there could also be community-level resources, including the distribution or allocation of funds for project-based initiatives, neighborhood-based initiatives, organization-based initiatives. The full details of how one might actually execute a program of reparations in the United States is provided in a book that's forthcoming by Kirsten Mullen and myself called From Here to Equality. But a program of reparations directed at black Americans still leaves open the matter of the high degree of general wealth inequality in the United States, and it leaves open the question of the reproduction of inequalities attributable to what happens with the preceding generation. So Derek and I have been arguing that there's another type of proposal that ought to be introduced as well. We refer to it generically as the baby bonds proposal. But it's not really a bond. The premise here is that every newborn child should receive a trust fund accessible upon young adulthood. This trust fund would be supported by federal resources. This would not be a savings account, nor would it be a trust fund that distributed a uniform amount of resources to all children. Actually, it would be graduated on the basis of a child's family's net worth. So for the richest families in the United States, if they have a new child, Derek says give them a $500 trust. I say $50, but you know, that's one of our sharp. For the poorest families in the United States, the allocation should be $50,000 to $60,000 for the child. Now, one other significant observation. This is not necessarily a program to be adopted in place of reparations. It could accommodate. However, it is a program that is race conscious but not race specific in the following sense: that there would be a disproportionate benefit. There would be a disproportionate benefit for black Americans because black Americans are so disproportionately concentrated at the lower end of the wealth distribution. However, if the program is treated as a complement to reparations, it provides the opportunity for a corrective for each cohort that is born anew. So the programs of reparations and baby bonds would facilitate creating a different type of future for America from the type of past that we have experienced before. It would not propel us towards a race-blind or a color-blind society, but instead it would propel us towards a race-fair or color-fair society. Indeed, it would be a society that, in effect, could maximize John Rawls's minimum prize, guaranteeing every American a good start in life.
We continue with Pasquale.
Where's the clicker?
Clicker's over here.
Thanks. Okay. So thanks for having me. So this is joint work with Daron Acemoglu, and of course the name of the panel is the future of work. And if you start thinking about the future of work, it becomes clear that it's going to depend to a large extent on institutions, and we'll be talking a lot about institutions, but also about technology. So in this talk, I want to talk about the role of technology for the future of labor. And this is a common theme in my research agenda with Daron, so we've been exploring what are the implications of technology in general, and in particular of automation for the demand for labor. And the main point that I want to make today is that when we think of technology, technology comprises very different processes. So we have to unpack these processes. On the one hand, we have automation, which is basically about substituting workers for machines in specific tasks. But we also have other technologies, such as the creation of new products or electrification and so on, that can create entire new industries and generate new sources of demand for labor. So when thinking about the future of labor, it's important to take into account or to try to forecast what's the direction that technology is itself going to take in the future. So to make the case today, I want to first start with a simple model, and I promise it's going to be a very simple model, where we're going to have tasks, and the key idea in our framework is we're going to be thinking about automation as the process of substituting workers for machines in some of these tasks. Now, the key implication is this model is that once you start thinking about automation in these terms, there's going to be a displacement effect. Automation is going to squeeze workers into fewer tasks. So initially, if you have a manufacturing plant and you start automating everything, at the end of the day, all that there's left to do is to push a button, but there's only so many of us needed to push the button, right? So that's the displacement effect. Now, I'm going to provide some empirical evidence to support the existence of this displacement effect. And because of the displacement effect, the main thing is that actually, contrary to many presumptions in macro and when you start with an aggregate production function, technology, in particular automation, can reduce wages and employment. And I'm going to use some data for the US on the adoption of industrial robots to show that at least in the US context, going back to the discussion over lunch, this adoption of industrial robots has resulted in lower wages and employment. But of course, that's not the full story. I mean, we know that in the past, we've automated pretty much all of agriculture. We also automated entire sectors of manufacturing, and we still didn't run out of jobs. So of course, technology is dynamic, and it's not only about automation, but we are also introducing new tasks, new sectors, and new products over time. So I also want to talk about the role of this other form of technological change, and conclude by saying that the future of work really depends on whether in the future we're going to be able to create all of these new labor-intensive products and the new labor-intensive sectors that can keep the demand for labor growing at a healthy rate. Okay, so that's the plan for today. So let's start with the simple model. So here's my model with pictures. So the key idea in our model is that any production process requires firms to complete a range of tasks. You need to complete a set of tasks in order to build a car, in order to produce a machine, and so on. And initially, maybe you can think that all of these tasks are pretty labor intensive. So initially, we tend to produce all of these tasks with labor. But over time, we are finding ways to automate some of these tasks. That means that instead of producing some of these tasks with people, we are now producing them with machinery or robots, and that's the process that we are calling automation. So at the end of the day, human labor is confined to a pocket of non-automated tasks, and that's the displacement effect, essentially. Now, the nice thing about thinking about automation in these terms is that if you assume that these tasks are there combined via a Cobb-Douglas aggregator, and I promise that this is the most technical thing that I will do in the whole presentation, you can also show that the aggregate production function is going to be a Cobb-Douglas in labor and capital. But interestingly, the share parameter in that Cobb-Douglas production function, the alpha, is going to be equal to the share of tasks that is performed by labor. So automation is going to do two things to this production function. On the one hand, it's going to increase the A term. It's going to raise productivity because it's allowing firms to substitute labor for very cheap machinery and efficient machinery, and that's going to increase productivity. But on the other hand, it's going to do it at the cost of reducing the labor share in the production function. It's going to make the production process less labor intensive. So that's the key idea, and that's how we are thinking about this transformation of production when you substitute labor for machines. Now, in this simple framework of the Cobb-Douglas production function, you can show that wages, they're just given by alpha times output per worker, right? We all have seen this equation. And the nice thing here is that you can see that automation is going to do two things to the demand for labor. So on the one hand, when you automate more tasks, that means that there are fewer tasks left to labor. That's going to reduce alpha, and that's what we call the displacement effect. Okay, so that tends to reduce the demand for labor, and that could reduce both employment and wages. But on the other hand, because of these efficiency gains brought by automation, you're going to have an increase in output per worker. That's the blue term. That's what we call the productivity effect. So at the end of the day, this doesn't mean that every time that we automate some task, we're going to have a reduction in labor. It really depends on how these two effects weigh against each other. You're always going to have some displacement, but maybe you get big productivity gains, and that can compensate for the decline in the labor share. Now, however, the fact that we had the displacement effect, however, brings us to some concerns about a single-minded focus on automation. So for instance, the fact that we have this alpha term, the share of labor falling in the economy, implies that very rapid automation could reduce employment and or wages. And in practice, actually the productivity gains that automation must generate in order to avoid this outcome are quite large. So let's think about an example. Let's imagine, for instance, that you have an industry, and the labor share in that industry, because of automation, goes down from 65% to 45%. So actually, that sounds big, but that's what happened to manufacturing between 1980s and 2010. Okay, so this is a transformation that we saw. So if you get that decline in the labor share, in order to sustain the same level of wages and employment, you need output to expand by 44%. Okay, so you need massive productivity gains in order to sustain the same amount of demand for labor. So that's why this displacement effect is so complicated, because we need to grow much faster now to produce the same level of labor demand. Now, even if we achieve that, automation is always, in this model, going to decouple wages from output per worker. So if you look historically, wages have grown at essentially the same rate as output per worker in a pattern that we call balanced growth, right? So output per worker increases, and we see wages increasing by the same amount. So growth, in some sense, has been good for workers in the world, because when you get more output, we get more wages as well. But the pattern sort of changed lately, because we've seen increases in output per worker that are not translating into higher wages. And our model, or more specifically, this displacement effect, offers an explanation. When this growth is driven by automation, you would expect output per worker to increase, but wages can remain stagnant because the labor intensiveness of production is falling. So I think that most of these concerns are really distributional, because at the end of the day, automation does increase the size of the pie, and someone in the economy owns those robots. So this is more concerns about the distribution of income between labor and capital, and the fact that perhaps with automation we can be going to a world where capital income is going to become more relevant, and then you're going to have more concerns about wealth inequality or capital holdings in that type of economy. But there's an additional problem with too much focus on automation, which I think is worth emphasizing. There was this question raised this morning about, well, if the robots are doing so much damage in the labor market, why aren't we getting the productivity gains? Okay, so that's sort of like a puzzle that was raised this morning. So let me say that I think that by itself, we tend to think that automation is going to generate magnificent productivity gains, but that's not the case. when you think about it, automation is not about creating an entire new process of production or dramatically modifying it or creating new products and industries. It's just about substituting workers for machines in the same tasks that those workers were previously doing. And as a result, the productivity gains from automation are really bounded. They depend on a comparison of how costly it is to produce with the robots versus how costly it is to produce with labor. So in particular, in our model, the productivity gains from automation depend on gamma, which remember is the productivity of each of these machines, times a comparison of the wage to the user cost of robots. Now, one implication is that if you only do automation, that's eventually going to run out of steam. Why? Because if you start displacing more and more workers, that's going to lower the wage, and it's going to increase the cost of robots, and therefore the productivity gains from automation are going to fall over time. So the main takeaway here is that automation is not a good strategy to produce sustained productivity gains. And actually, when you start getting to the region in which automation starts producing low productivity gains, the labor market implications are going to worsen, because we're going to be left with the displacement effect, but not with these productivity gains. So I think that actually there's no paradox at all. The fact that automation has not been pretty good at increasing productivity during the last 30 years is precisely the reason why automation has been so damaging for labor markets. In other words, we should fear the mediocre robots and not the very good robots. The very good robots, they're going to bring high productivity gains that are going to be able to sustain employment growth. But the mediocre robots, they're just going to displace workers but not create large productivity gains. So in particular, an initial wave of automation can be more damaging because subsequently we're going to start improving on all of these robots and so on, and we're going to start getting more of the productivity gains. But at least initially, if all we do is focus on automating more and more and more tasks, we're not going to be able to increase productivity. We're just going to be left with displacement. Now, of course, that's a model, but let's see what the data says. So in order to provide some evidence, I want to focus on the case of industrial robots in the US. Industrial robots are mostly used in manufacturing, so this evidence comes from a very specific context. But I think that in general, this evidence is telling us something general about automation, that automation really is represents a class of technology that can reduce the demand for labor. And now it depends on labor market institutions how the adjustment is going to take place. Whether you're going to see wages declining or employment declining, that's going to depend on the labor market institutions. But at least the thing that the technology does is perhaps to reduce labor. That doesn't mean that it reduces total output. It's going to raise total output. It's just going to reduce labor demand because you don't need as many workers to produce now. So this figure, this is how a modern car manufacturing looks like. And you can see a bunch of yellow arms building cars. Those are the industrial robots that we're going to study in this paper. And in general, they are defined as automatic and multi-purpose machines with several axes that are suitable for industrial applications. So the key feature of these robots is that unlike other previous waves of technology or other forms of capital, what these robots are doing is essentially the same thing that the workers were doing before. So they're just substituting for workers in these very specific tasks, in this case of welding. But to advances in the robot technology, they're getting more versatile. So now they can do machining. So before you had a guy that was operating like machines in a factory. Now it's a robot operating other machines. Before you have a guy that was doing the assembling. Now you have a robot that is doing the assembling. Before you have a guy painting, now it's the robot painting. So we think that there's a very direct link between the adoption of these robots and the substitution of human labor for machines at the task level. And as a consequence of these technological improvements, there's been a large increase in the number of robots from 1993 to 2014. So in the US, there was a 5-fold increase from 2 to 10 robots per 1,000 workers. So we're going to study what is the implication of this transformation, in particular of the manufacturing sector for labor demand, employment, and wages. So we're going to use data from the International Federation of Robotics. And the first surprising thing here is that there's such an organization, but there is. And we're going to use data from the period from 1993 to 2007, which precedes the Great Recession, because we don't want to get into the recession period. And essentially, the first thing that we want to do is, the general idea that we want to do is we want to look at the industries that are adopting the highest numbers of robots, and we want to ask what's happening to employment in those industries, to wages in those industries, but also, more importantly, what's happening to the local labor markets in the US that are specialized in those industries. So the first thing that we need to do is sort of to extract a measure of how much of this adoption of robots is driven by technology, because there might be adoption of robots that is driven by US-specific things, and that's going to be endogenous variation. We don't want to capture that. So we're going to use the adoption of robots among European countries as an instrument for the US adoption. The idea is that, I mean, this is like a thing that I learned when I started this paper. The US is actually not the world leader in robotics. The world leader in robotics are the European countries and the Japanese. So the US is just adopting the technologies that these people create, right? So they are the followers. So in some sense, if we have data on the technologies that the Europeans are inventing, then that gives us an idea of exogenous technology that now became available for the US to adopt and that we are going to use that as an instrument. And in line with this idea, when you plot robot adoption in the US, each of these balls is one industry, against this measure of robot exposure computed, use the increase in robots among European industries, you see a high correlation. So essentially, the US is adopting robots in the same industries where robots are making inroads in Europe. So this suggests that it's technology driving the adoption.
So what's the scale?
So it's a logarithmic scale, and this is robots per 1,000 workers, increasing robots per 1,000 workers.
Not the value of robots. Like
is the number. Or most robots are just like one of these big yellow arms. It's just that they're programmed to do different stuff. But they're quite standard. Yeah, they have like a similar price and so on. Okay. I mean, there's some variation. There's like 6 types of robots overall, but there's not much variation. It's not like a robot in a car manufacturing plant is going to look dramatically different from a robot in a petrochemical plant. Big yellow arms. Not of them yellow, of course. That's the only difference. So the second thing to see here is that there's a lot of variation. So of course, most of these industrial robots are in manufacturing. So you see manufacturing industries, but especially in some industries within manufacturing. So car manufacturing is full of robots. Petrochemicals and electronics are full of robots. But also you have other industries such as textiles, paper and printing, construction, and utilities that are lagging behind in the adoption of robots. And this is the variation that we are going to exploit. So first, let's see what's happening at the industry level. What's happening to those industries that are adopting robots. So this figure plots data on the change in the labor share by industry during our period of analysis against the exposure to robots. And you can see that there's a clear negative relation, meaning that these industries that are adopting robots are also experiencing a decline in the labor share, which is consistent with our model. They're becoming less labor intensive. In particular, look at the car of plastic and chemicals and car manufacturing. The labor share in those two industries went down by almost 20 percentage points. 20 percentage points. That's huge, okay? So the only reason why the labor share in the overall economy didn't fall as much is because these are small sectors in the economy. Now, interestingly, not only are these industries becoming less labor intensive, and this is also related to the question this morning, but they're also producing more. So when you compare industries according to the increase in output during this period, you see that within manufacturing, the 3 industries with the highest increase in output during the period of study are car manufacturing, petrochemicals, and electronics. Okay? Car manufacturing and petrochemicals grew at a rate of 4% per year. Pretty healthy productivity growth. Okay? Electronics grew at a 17% growth rate per year. Huge productivity growth. But essentially, this suggests that at least when we look at the industry level, these robots do seem to be raising productivity. It is just that they're not widely adopted across all of the industries in the US. So this suggests that, again, these 2 figures, there's a displacement effect, the labor share is going down, but there's also a productivity effect. These industries are being able to expand their output because they're using robots, and at the end of the day, we want to understand then what happens to employment and wages. Now, let me make a parenthesis. I believe that essentially our measure of robots is speaking to a broader transformation of the manufacturing sector. So this is data of the labor share in manufacturing from the BEA. And if you look at it, the labor share in manufacturing was pretty flat until the late 80s. Pretty flat and almost the same level of the economy. But then, starting in the late 80s, you see a dramatic decline in the labor share in manufacturing. So to us, this is consistent with this increased emphasis in industrial automation in manufacturing. So this is something that changed. In the past, yeah, there was technical change in manufacturing, but that technical change was about creating new products, new industries, improving productivity. But at least since the late 80s, it seems that most of the emphasis in manufacturing was about automating. And that's why you see that big decline in the labor share. And of course, we want to understand what's the implication of this big transformation for the US economy as a whole. So this is how we're going to do it. We want to look at local labor markets. Why look at a local labor market? Because a local labor market is going to tell you how the market essentially adjusts when workers can relocate, when wages can adapt to the fact that maybe you can move to another occupation and so on. So for each labor market in the US, these are commuting zones in the US, we're going to compute a measure of exposure to robots during our period of analysis. And the way that we're going to do it is using something that is called a Bartik instrument. So that essentially interacts the baseline employment share of that industry in that commuting zone in a baseline year. So let's think 1990, times the increase in robot adoption in that industry. So this is telling us, this is identifying what are the regions in the US that house the industries that experience the largest increase in robot adoption, where workers are getting more competition from these big yellow arms, okay? And when you put it on a map, that's how it looks. Okay, so the blue areas are the areas where you have more intense robot competition. And not surprisingly, there's a lot of robot competition in Michigan because of car manufacturing, but also in Texas because of the petrochemical industry, also in Oregon because there's a lot of robots in wood and furniture, right? So those IKEA things are being made by robots now. I don't know if they're being assembled by robots. That's a different question, but at least they're being made by robots. So now we can ask ourselves, okay, what's happening in the blue areas relative to the rest of the country? And we can control for a bunch of characteristics of these commuting zones. And this is what we find. This is the figure when we plot our measure of exposure to robots, sorry, the change in the employment to population ratio, the EPOP that we've been discussing the whole day, against our measure of exposure to robots. And you can see a clear negative relationship, suggesting that areas that are more exposed to robots experience a decline in employment. This is not driven by Detroit, which is the big blue ball here, that has a lot of competition from robots because of the car manufacturing industry. If you remove Detroit from the sample, you get the red regression line, which is, if anything, more negative. Okay? So overall, we find that one additional robot per 1,000 workers reduces the employment to population ratio by 0.4 percentage points, wages by 0.7%. And interestingly, there's no evidence of migration or of expansion of the service sector. Right? So it's not that people are just relocating to services or moving out of these communities. What's happening mostly, or the adjustment, is that most of these people seem to be dropping out of the labor force. Okay, so that's interesting because in the past, when we had some of these local shocks, the adjustment worked that people just moved out of these communities and they went to more prosperous communities, and that sort of eased the adjustment, but that's not what's happening now. Okay, so I have 1 second, but can I borrow 1 minute?
You can do a minute.
Okay, awesome. So let me talk about new tasks, because of course this is not the whole story. I mean, the same thing happened to agriculture and other sectors in the past. So if you're looking ahead, we want to understand what are the counteracting forces in technology that are there. So the first thing that is there is that first, I mean, obviously there's not only a fixed set of tasks, but over time we managed to create new tasks, right? And that generates additional sources of employment. So for instance, when you look at the data, it turns out that the occupations that are growing faster in the US are not traditional occupations that have always existed but that we didn't automate. Are occupations that have new job titles. Occupations where people are doing jobs that are just new and that didn't exist before. So this suggests that there's not only like a fixed amount of tasks and that you're automating of those tasks, but there's also like a very dynamic process where you're also introducing new tasks to the labor market. Okay? So the future of labor really depends on how these two technologies weigh against each other. Like my summary is that at least in the US, there was an increased emphasis in automation during the last 30 years. And now the question is if looking ahead, we're going to start emphasizing more of these new tasks, if we're going to be able to create new sectors, new products that are labor intensive to soak up all of this excess labor that is out there. So that's the question and that's the challenge, in my opinion, for US labor markets. Thank you.
Thanks a lot, Pasquale. So we have the last speaker of the panel and the conference, Maya Rosenslater.
This is the clicker. All right. Well, thank you so much for having me and for inviting me to be a part of this. Thank you to all of you for sticking around until the very end. This has been a very interesting panel. We've covered a lot. I'm going to switch gears, talk about the interaction between work and family, and particularly parents and kids, and talking about some of the main work-family policies that have been brought up throughout the day already. So just to motivate, the majority of American parents must balance work and family. So in the most recent year of data, 71% of mothers, 93% of fathers participate in the labor force. For mothers of infants under age 1, the labor force participation rate is 59%. I think an important additional statistic is that nearly a third, 30%, of children live with only a single parent, most commonly the mother. So work is not, you can frame this in the context of choice, work, family, balance, and so on, but for many families, work is a necessity. So understanding the consequences of policies aimed at working parents or people that have family obligations is important. I'll spend most of my time talking about paid family leave, which is a policy that provides workers with time off work with at least partial wage replacement to care for their newborn, newly adopted children, as well as severely ill family members, as is the case in the United States. I'll discuss at the very end a little bit about public preschool. So what's the current US policy landscape in terms of family leave? So this has come up already. So one interesting point that I think was made in the very first presentation, which is that changes in the labor force participation cannot possibly be explained by changes in paid family leave in the United States, but that's because the United States has not had a paid family leave policy over this whole time period, right? So there is unpaid leave that's available through the Family and Medical Leave Act, which has been the case since 1993. It offers 12 weeks of unpaid leave to eligible workers. It offers job protection, continued health insurance coverage if such coverage is available, but it has fairly stringent eligibility requirements, meaning that only about 60% of private sector workers are eligible. So this means that the remainder of the workforce, and if the workforce wants to get any paid leave, that's left up to the employers. So, I'm in California. A lot of times if you just talk to people in the Silicon Valley, they think all employers provide family leave because they hear about Facebook and Google and so on. That is not the case. So according to most recent data, 14% of private sector workers have access to PFL from their employer. And this access is low and also very unequal. So 23% of highest 10% of wage earners have access. Only 4% of the lowest 10% of wage earners do. What about the state level? So the state level, there's a bit more going on. So first of all, mothers, in particular birth mothers, mothers who have given childbirth, are eligible for approximately 6 to 8 weeks of paid maternity leave through the temporary disability insurance system. And this has been the case since the 1978 Pregnancy Discrimination Act. This exists only in the states that have such a system, which is 5 of them that are listed there. Additionally, since 2004, California was the first state to enact a state-level PFL program that's in states that already have TDI is on top of that system. So these states vary a little bit in terms of the exact details of what they provide, in terms of statutory leave duration, whether or not it's actually job protected, and how it's funded. Most of these are funded by mostly employee payroll taxes. Some have a little bit of employer taxes as well. They have much wider eligibility than FMLA. So basically there's, for instance, no firm size requirements. Almost everybody is eligible. And as I mentioned, they're integrated with state temporary disability insurance systems, meaning that mothers can get leave both through that system and through PFL. So I'm going to talk a bit about who uses the program and if there's any inequalities in access and usage of this program. I'll talk about the impacts of PFL on parental labor market outcomes, focusing on mothers, impacts of PFL on children, on employers, and then at the end, I'll talk a bit about public preschool, thinking about what are the effects on the next generation. So first, understanding take-up of leave requires having good data on that, and that data has not really been available until very recently. So myself and co-authors Sarah Banna and Kelly Bedard got some data from the California Employment Development Department, administrative data on paid family leave claims, as well as temporary disability insurance claims, that has allowed us to sort of inform this question using data from nearly from the whole decade, the first decade of the first state in the country to implement such a policy. So here's just some aggregate trends. So an initial concern with these programs is that people wouldn't be aware of them, or because in the case of California, there's actually no job protection that's in the law, that maybe people wouldn't be using them as much. And so what I'm showing you here, that in general, there's been steady increase in usage. So bonding claim refers to claims taken to bond with new children. Caring claims refer to claims taken to care for ill family members. Both have increased. Bonding claims are much more frequent than caring claims. Women are much more likely to use the program than men. So our best estimates suggest that in the most recent year of data in 2014, 47% of employed mothers who would have been eligible for the program used it, 12% of employed fathers. You know, the 12% of employed fathers has increased from 5% in the first year of the program. So the relative increase is large, the absolute not as much. In terms of the interaction with the temporary disability insurance system, nearly all women take advantage of both. So they extend their leave duration, meaning that average leave duration is about 12 weeks for women. By contrast, most men take less than the maximum amount they're allowed to take under the program, which is 6 weeks. So conditional on taking, this is again a selected sample of people who actually take any of this program, conditional on taking any leave, less than a quarter take the maximum amount. I'll skip carrying leave in interest of time. What about differences across industry? So what we do here is we compare the distribution of claims in our employment development data, the administrative data, to the distribution of individuals who would be eligible to take this program in the March CPS. So in the case of bonding, which is what I'll focus on here, which is the first panel there, first 4 columns, this is going to be employed parents of children under age 1. Okay, so what you see is that remarkably, so the EDD columns 1 and 3 show the distribution of claims across industry amongst people using the PFL program. The columns 2 and 4 show the distribution of individuals who are eligible for the program in the CPS, and then bold numbers denote differences that are statistically significant. So what you see is that there's not really any bold numbers in terms of for women in industry, which means that women are approximately equally represented according to their industry in the bonding claim data. For men, however, you see some dramatic differences. So in particular, men in retail are overrepresented amongst PFL claimants. Men in construction are underrepresented, for instance. The other interesting pattern, and it's not actually that surprising, which is that individuals in smaller firms are less likely to use the program than individuals in larger firms. And that's because individuals in smaller firms are not eligible for job protection, which individuals in larger firms are through the Federal Family and Medical Leave Act. Low-income, low-earning individuals are less likely to use the program than higher-earning individuals as well. Okay, so this is just to summarize what I just said. Let me just highlight some of these facts about firm size. I think the pattern across industries is really interesting. It is consistent with the idea that the family friendliness, or whether other people are using this type of program, and how common that is, that may be important for generating usage among the program and for generating more gender equal participation in the program, right? So there's not much difference for women in terms of across industries. For fathers, however, there's substantial differences. Okay, let's move to labor market outcomes. The idea behind family leave programs, right, is that they're designed to help individuals balance the dual and often conflicting responsibilities of family and work. Theoretically, there's ambiguous effects on what would happen to parents' future labor market trajectories. On the one hand, for individuals who would have otherwise quit, these programs might increase job continuity, wages, employment status, and promotions, and so on. On the other hand, for individuals who would have otherwise taken no leave and not stayed out of the labor market for that time period, that could have the opposite effect. There's also this concern that's often brought up in criticisms of PFL programs that because women are much more likely to use these programs than men, employers might discriminate based on that knowledge, right? So they might, as a result of that, be less likely to hire women or to be giving them lower wages. So what do we know about which of these tends to outweigh the other? So in a paper with Jane Woldfolgo and Chris Room, we looked at the effects of the introduction of California's policy on maternal leave-taking and labor market outcomes. So first, we find that consistent with what I was showing you in the administrative data, the program increased leave usage substantially. In fact, it doubled it. Importantly, the estimated effects were the largest for the least advantaged mothers, those who are unmarried, who are minorities, who have low education levels, which is, again, unsurprising in light of the fact that they used to have very little access to any leave. And if anything, we find positive effects on labor market trajectories among employed mothers 1 to 3 years later. What about fathers? So in some subsequent work with a lot of the same co-authors, and also in a paper by Baum and Room, we've looked at fathers of children under age 1, and they actually increased their leave taking in relative terms by a substantial amount. But the base rate is so low, so in terms of absolute amounts, it's less than 1 week, basically. We've looked at whether it increases both joint leave taking, so when both parents are on leave at the same time, versus when fathers are on leave with the child and the mother returns to work, and we see increases along both of those dimensions. And again, this is from the Bauman-Room paper, there's evidence of positive labor market effects for mothers. One sort of interesting concern that has been raised with regard to these types of policy that echoes some concerns in other social insurance programs such as UI is, well, if you make the benefits too high, if you make the wage replacement too high, well, maybe people are going to stay out of the labor market too long, and that's going to have all these adverse consequences, and maybe there'll be a gender difference in this, and this could create other avenues for discrimination. So we tried to look at this, again using this California administrative data, to look at what's the effect of the benefit amount on maternal labor market outcomes as well as future program usage. We use what's called the regression kink design, which means that we're comparing individuals whose earnings are such that the amount that they get through their program is near the maximum benefit. Okay, so basically the way that the benefit system is structured is that there is a wage replacement rate, like say 55% of your prior earnings, but there's a cap on that. So individuals who earn more than where that cap hits just get the maximum benefit amount. So we leverage this variation to try to identify the effect of the benefit amount on these outcomes. A big caveat is because we're focusing on that variation, our sample is high earners. But if anything, these are the individuals, high earning women, are the ones for whom we might worry there could be negative consequences on future labor market trajectories in terms of these are the ones that are potentially going for promotions and so on, where things like Claudia Golden talks about being FaceTime and so on, being at the workplace matters a lot. So we find no evidence that a higher weekly benefit amount leads to any worse future labor market outcomes for women in our sample. We can rule out very small elasticities that are orders of magnitude smaller than those found in other social insurance programs. If anything, we seem to see a positive impact on employment 1 to 2 years after the leave. And we also find this interesting effect, which is that having a higher benefit during the first period of leave predicts the likelihood that the woman uses the program the next time. We don't think that it's being driven by fertility. It's not that people are more likely to have more subsequent children. What we think is going on is that having a higher benefit during that first period of leave just increases one's enjoyment and experience on this program, and therefore they're more likely to use it the next time. Briefly, what can we learn from other countries? So again, I think as was mentioned during lunch, the US is an outlier in paid family leave in that it doesn't have a national policy. In Europe and Canada, policies range from the shortest is, I believe, like 2 months, but most are a year or longer, up to 3.5 years, 70 to 100% of wages replaced. There's a lot of work on these policies. I've written a review chapter. Olivetti and Pietrangolo have written another one. Here's the general conclusion. Implementing and extending these policies, people tend to use them more, so people take up these policies. The take-up effects are typically larger for mothers than for fathers. In terms of what people worry about, which is that if you make a leave policy a year or longer, is this going to have detrimental consequences for labor market outcomes? I think the general conclusion from this vast body of research is that paid family leave up to 1 year in length has either null or zero or positive effects on maternal labor market outcomes. It's longer leaves, so leaves longer than a year, that seem to have some detrimental consequences on women's labor market trajectories years down the road. Let's talk a little bit about children. So almost all of this conference has been focused on employment, but this is a policy that is about work and family, and therefore it's affecting not just the parents, but the goal is to also improve children's outcomes. There's a number of channels through which a paid family leave policy could impact kids' outcomes, be it through maternal stress channels, more time spent with kids, breastfeeding, financial resources. So again, there's a lot of research, mostly set outside of the US, because that's where these policies have been implemented and extended most frequently, that looks at a variety of child outcomes. Most of these studies that look at extensions and relatively generous policies, so say going from 1 year to 1 year and 3 months in Sweden, these studies tend to find no effects, 0 effects on kids' outcomes. I think that's not too surprising because, we think that the marginal effect of an additional month of paid family leave is probably different when you're already getting 1 year versus if you're going from 0 to something. And in fact, when you look at research that studies the introduction of shorter programs, these studies tend to find positive effects on children's outcomes, both in the short term and in the long term, with effects concentrated amongst the least advantaged families. What about employers? So I think, we've talked a lot about what happens to the workers and the families. These are sort of some of the benefits, potentially, of these policies. I think a lot of people also worry about the costs, and rightfully so. So as I mentioned, most of the US state-level programs are financed almost entirely through employee payroll taxes. So there's sort of limited direct costs to the employers in that they're not paying into the system. But of course, we worry that there might be other costs due to employers having to hire temporary replacement workers, coordinating schedules, and so on, dealing with what happens when a worker is on leave. And in fact, we worry that these costs might be disproportionately burdensome to small businesses. And in fact, opposition to PFL programs is arguably strongest from small business groups and from organizations like the Chamber of Commerce. On the other hand, you might think there could be benefits, which is that if workers have access to paid family leave, maybe you see reductions in turnover rates, improved employee morale, productivity. So the big caveat to what I'm about to say is that there is very little research on employers. So this is, I think, an active area that we need to learn a lot more about. There's some survey evidence. So Applebaum and Milkman surveyed firms in California after the policy went into effect. So they couldn't look like before and after what happened. But they went in and surveyed and sort of asked them how they feel about what's going on. The general conclusion is that most firms report that there's either no effect or maybe a small positive effect on things like employee productivity, morale, and costs. So we're actually trying to do in some joint work with Ann Bartel, Chris Room, and Jane Wolfvogel. We've been doing this kind of survey work, but trying to go into states both before and after a paid family leave policy goes into effect. So we did this in Rhode Island, where we surveyed Rhode Island before Rhode Island's policy went into effect in 2014, and we also surveyed Connecticut and Massachusetts. We're also in the process of doing this in New York, New Jersey, and Pennsylvania. New York's law went into effect in 2018. We're sort of, the conclusions that we're getting so far, this is very preliminary, so do not cite this, is that there's basically no effects. We're finding zeros by and large. We're a little bit underpowered in Rhode Island. Rhode Island's a small state, so therefore we're hoping to learn a bit more from the bigger states we're serving now. Administrative data in California suggests there's also very little or zero effects of PFL on turnover rates or things like total payroll. Okay. So I think, since in the interest of time, let me skip a lot of this. I think that the general idea is that paid family leave policies seem to have some benefits for both workers and their children, so the workers and their families. And paid family leave specifically, especially compared to unpaid leave, might reduce inequalities in these outcomes. And these benefits to the employees and children seem to come at little or no cost to employers, with the caveat that I already mentioned that more research on employers is needed. Let me use the last minute of my time to talk about a different work-family policy, which is public preschool. Okay? So after paid family leave ends, kids still need to be taken care of once their parents go back to work. So what do we know about preschools? So there's been a substantial amount of work on targeted programs in the United States, such as Head Start, but then also more intensive interventions, basically finding really large positive effects. And then a limitation of these studies is they come from small sample sizes and use survey data with self-reported outcomes. Scandinavian studies in recent years have looked at universal programs that cover kids from all socioeconomic groups. We think that the Scandinavian policy landscape today has less relevance for the current US policy setting. So what do? We turn to early 20th century Denmark, which is surprisingly more, there's lots of differences between early 20th century Denmark and the US today, but one similarity is that they had no paid maternity leave, basically no other programs for working parents. We look at the introduction of the very first government-provided public preschool program in Denmark and use data on nearly 1 million individuals to track their long-term outcomes as well as the outcomes of their kids. So we're not looking just at first-generation outcomes, we're looking at second-generation outcomes. And we're finding large effects on educational attainment, income at ages 30 to 60, survival beyond age 65, so reduction in mortality, as well as the education of the next generation. So I'll conclude on this point, which is that public preschool, I spend most of my time talking about how work-family policies affect the current generation and parents who are working, but public preschool is one example of a public policy that not only is designed to support labor force participation among today's workforce, but it seems to also contribute to greater labor force participation and productivity in future generations. Thank you.
Thank you. Okay, we would open the floor to questions to the panelists. Yeah. Can you wait for a microphone? Let's go.
Thank you for your papers. I have a more general question. Based on your experience of people in this room, in a low-income area, apart from a job, what's the most effective wealth-generating strategy?
Are you asking me?
Anybody, the panel on this room, I'm curious to know.
I mean, I don't know the exact answer, but I think one thing that we should be cognizant of is the distinction between income and wealth. I think far too often we conflate the two. I think the statistic that Sandy presented, which is the income across race, doesn't close the racial wealth gap, that blacks with moderate income have oftentimes less wealth than whites with low income. I think the main point is that wealth begets more wealth, that it is that endowment that allows somebody to purchase an asset that will passively appreciate over their life at a key juncture. That's how most Americans build their wealth. So if you're white and inherit a house, that's a mechanism to build your wealth irrespective of your income. If you're black and you inherit caregiving responsibilities because of poverty in your family, then that's a mechanism that won't allow you to build your wealth despite your income.
Fabrizio?
Question for Derek and Sandy. So the plans you talk about, $60,000 wealth bond for every kid and guaranteed work, those seem pretty expensive plans. I mean, at least in the short term. Maybe in the long run they pay off for themselves, but in the short term, how do you think of paying? Like, is it wealth tax, income tax, and who to pay that tax? Do you have any ideas on that?
Quite a few. When we get to the question of how you pay for these things, I kind of reached the point where I think this is a bit of, I'm not accusing you of this, it's a bit of a refuge of scoundrels. Because if we think about the Great Recession and the amount of resources that were generated overnight that were distributed to the investment banking community, I'm just amazed that anybody asks how we can pay for much of anything. We clearly can, and we don't necessarily have to pay for things by taxing first. If I was a passionate MMTer, I would argue that you actually generate the taxes by funding the programs, but I won't go that far. So let me distinguish between the two proposals. So the baby bonds proposal is one in which we estimate that the average sum of money that would go to each newborn cohort of infants would probably be somewhere in the vicinity of $25,000. There are 4 million new infants typically born in the United States, so the program would cost approximately $100 billion annually. That's actually not a very large sum of money in the general scheme of things. Plus, if we don't allow the young people to access the funds until young adulthood, say at the earliest 18 years of age, we've got a gestation period for the fund of at least 18 years before the first payouts have to be made. So there would be an annual incremental increase to the fund that would be associated with each cohort that is born. And then there would also be a commitment to providing a real rate of interest on the fund of at least 1%. But by the time you start to make payouts, you should have built up a fund that would be of sufficient magnitude to cover the expenses. But $100 billion is not very much in terms of the overall federal budget. So I guess I would argue that you basically fund that out of existing revenues. On the other hand, the federal job guarantee is a more expensive proposition. And I think you offered a modest estimate of the vicinity of $600 billion.
With the current employment.
Yeah, and I think we both said that, it could easily go to $1 trillion or so. But the cost savings are both implicit and explicit. The implicit cost savings are associated with the health, the social benefits that are associated with having a project like that. But the explicit savings would be associated with the reduction in a variety of entitlement programs that are supposed to address poverty and unemployment that would no longer have to be deployed. And I believe that one of the estimates we found of the cumulative expense associated with anti-poverty programs was somewhere in the vicinity of $750 billion. So the conservative estimate you gave was actually less than that. Yeah. And the $1 trillion estimate would require an incremental increase, but the program would fluctuate in terms of size and expense depending upon where we are in the business cycle. So, my sense is that both of these programs are entirely fundable, even if you don't go the route of believing in modern monetary theory.
Margaret?
Yes, I have a question for Pasquale and also for you, Sebastian. So we heard at lunch about how different countries have chosen different grand bargains, if you like, in terms of their labor market institutions. And Pasquale, you told us that adoption of robots and other automation technologies have occurred roughly simultaneously in a bunch of European countries and the United States. So my question is there any lesson we can draw from that in terms of how to make the transition in the US work more smoothly? And for Sebastian, I know you've studied Germany. Do you have anything to add to that as well?
Sure. I can tell you maybe about the German experience. So inspired by our own, so Pasquale's study, we did something relatively similar in Germany and looked how different industries responded to this increase in robots. And actually, to understand the German context, you have to understand that it's pretty hard in Germany to lay off a worker when times are good. So what German firms do, if they get the robots, they cannot lay off these guys actually. So what they do is they retrain the workers and put them into different occupations, different tasks within the firm, because these are institutional constraints. Now, this is not to say that robots don't kill any jobs in Germany. Instead, what happens is these firms, they tend to hire less new workers, which they would have hired if this advances in technology wouldn't have made. Now, it's not clear how directly a lesson you can draw for the US, because you have this rigid firing laws in Germany, but I think it just tells you something. The margin of adjustment can be very different.
Yes. So what happens to wages in your study as well? I think that's an important point.
Wages are hardly affected. So.
Okay, so like the other thing that I would add, I mean, besides the fact that clearly, like the way I think about it is that there's a reduction in labor demand, and the way that firms end up accommodating that reduction may vary depending on the labor market institutions. So you may accommodate it by firing people, you may accommodate it by hiring less people on the other margin. But the other thing that I would add is that also the context is very different. So when you look at the context, Japan and Germany and many countries that are spearheading the robot revolution are aging very rapidly. So they're experiencing a demographic transition that is way more rapid than the one in the US. So for them, investing in robots is actually a thing that they have to do if they want to remain productive, because they need to substitute some of these workers that are retiring of the labor force. So I think that the adjustment for them in that sense is also easier, because you have a bunch of workers that are just starting to retire, and then you just phase the adoption of robots with the retirement of workers. So in that sense, I think that comparing the US to the Japanese context or to Germany probably there are some lessons for institutions, but also the context itself is different.
Pasquale, I had a couple of questions.
Yes.
I thought your presentation is one of the most fascinating that I've ever heard on automation.
Thank you.
So, the first question concerns the position of the advocates of universal basic income, which I think is an implication, is driven by the belief that alpha will go to zero. So I wanted to hear whether or not you think that that's actually a realistic prospect. And the second thing is, one would presume that it's the most expensive areas of labor that would be substituted first. But we don't see robotization of, say, the practices of physicians or lawyers. So is it a sheer engineering issue with respect to the development of artificial intelligence, or is there something more going on?
Absolutely. Okay, so let me first talk about universal basic income and a little bit of policy as well. So I think I'm with Jason. I'm totally on board with your comments on universal basic income that you made during the lunch. I mean, if you look at this figure, these losses, these employment losses from robots are highly concentrated in certain regions among certain workers. So in that sense, universal basic income seems like a very bad way of addressing the problem, because you can do better just by sending some targeted transfers, right? Like, we know who are the workers who are losing their jobs. We know where they are. So I think that just setting like a universal basic income is just the wrong way of thinking about the problem. Having said that, I'm also super sympathetic to the idea of a wage subsidy. Why do I think that a wage subsidy will interact nicely with this view of automation that I've emphasized today? Remember that the problem, or the reason why these firms are automating in some sense, is because it's becoming more attractive to produce with capital rather than with labor. So wage subsidy is also going to shift away the focus of these firms away from automation a little bit. It's going to make it more attractive for them to, instead of adopting that robot, invest in creating a new job for that worker, because that job is going to be subsidized. So I think that wage subsidies have this additional advantage that they take away that single focus on just automating jobs and automating jobs. So I think that there's a nice interaction there that can be discussed. And regarding your last question, I think that maybe that's the big question today, whether artificial intelligence is going to do with all of these highly educated jobs the same thing that industrial robots did to manufacturing jobs. And maybe that's where we are going.
That's a big puzzle, yeah.
Question or whatever.
I was trying to think about whether there was any sort of common ground to be found between the comments that Casey had to make and the comments that Derek and Sandy had to make in terms of attractiveness of working and the incentives to hire people and so on. I guess one thing that I do worry about with respect to the incentives to hire people is that in a world where we've linked provision of health insurance to employment, that there really is a disincentive to hire low-income people, because the marginal, when you hire somebody, you also have to provide health insurance. That's a really big cost compared to the wage that you're paying those people. So I wonder if, as we're thinking about trying to reconfigure what's going on in the labor market, whether one thing that we shouldn't be thinking about is detaching provision of health insurance from people having a job. It's something that you would think should be a right. That's something that everyone should have, and if the decisions are if you remove that from being attached to employment, that could have pretty positive effects, I think.
Yeah, there's two aspects to your question. One, I would totally agree on the low-skilled people. This is really dramatic. I made some estimates. The employer penalty, when you take into account how it interacts with business taxes and so on, low-skilled people have to work 9 hours a week, 52 weeks a year to provide enough value just for the employer to pay that penalty. Forget about provide value for the customer and so on. I mean, that is really dramatic, and I don't see how any economist could say, oh, we're going to put on a 9-hour-a-week tax and it's not going to do anything to these people. I mean, it seems to me the demand for their labor has to suffer from that. I think there's some evidence as well. But the other part of it is in terms of the middle and higher skilled people, I'm in a mixed feeling on that. It depends what you're doing instead. The subsidy for employer-sponsored health coverage is one of the few things that doesn't obey that law with the ox, because you actually have to work to get that. Unlike all the other things where the assistance goes to the people when you don't work, this is one of the things, one of the perks of working. And if you take away one of the perks of working, then we're just pushing harder down on that cart. Now, in the textbook, what you would do is you would take away that perk, cut the marginal tax rates across the board because you would be bringing in more revenue, and then it would come ahead. Usually the proposals don't involve that, or if they do, they kind of double count that, and that's where I have a problem.
So my response is I don't think there's a lot of common ground. I think Casey had seems like he alluded to a causal effect of marriage. I would think marriage is endogenously related in the model, that marriage is as much of an outcome as it is an input, and perhaps even more so. I mean, how could one talk about marriage in the black community without incarceration and labor market discrimination in the first place? I would also say that your larger point about we conceive of an economic bill of rights. So frankly, single-payer health insurance would be part of that economic bill of rights, and that would enable employers to reduce their costs in that domain. But largely, our program is intended to crowd out bad jobs, but should facilitate good jobs. It should facilitate good jobs because it's building up our national infrastructure that's both physical and human. So workers should not have bouts of unemployment. Workers should have better benefits and health care and provisions anyway, which should lead to greater productivity in general. So I think that history has shown us through WPA and CCC. Now, those jobs were not designed to compete directly with the private sector, so they're not completely complementary to what it is we're talking about. But nonetheless, they did facilitate an infrastructure in the U.S. that led to growth. So that would be the answer.
We have time for one last question, maybe? In the back, yeah?
Yes.
First in the back. We can do your question afterwards. We do too. Okay.
So Rob Grunwald, Community Development Department here at the Minneapolis Fed. So a question about paid family leave research with Mia's presentation. It's always interesting to look at the phenomena of the introduction of paid family leave in Europe, Canada. The type of research that you're doing here, looking at California and where it's been introduced at a small level, has that research been done when that paid family leave was introduced in these other economies, and any implications for what they noticed in terms of their labor markets and the effects on the labor markets, and also any child effects in those countries due to paid family leave?
Sorry, just to clear, you're asking about what the research says in other countries when they were first introduced.
Exactly.
Is that right? Okay, so I think the best evidence on that comes from Norway. They introduced their first paid maternity leave policy in 1979. And people have looked at, not myself, but others have looked at the consequences of that introduction on both labor market effects, men and women, and then subsequent expansion. So the policy has expanded over the years. And then importantly, people, because it was now several decades ago, you can actually track children's outcomes. So I think the general conclusion is that there's a nice paper by Gordon Dahl and co-authors that looks at this in terms of the labor market effects. They tend to find zeros, so there's neither a positive nor a negative effect for parents, which I think is actually, I think there's a lot of concern that the long policies are going to be detrimental, especially for women's labor market outcomes. They don't find any evidence of that. And importantly, another paper looks at children, and they find that children that were covered by the policy, so whose mothers were eligible by the policy, when compared to mothers who were giving birth just before and were ineligible for the policy, have higher likelihood of high school graduation and then higher earnings in adulthood. And this is all driven by kids from disadvantaged families, so kids from mothers who are less educated.
Okay, last question, I promise, and then Mark wants to say something.
Deals with the economic Bill of Rights as it relates to those.
There's a microphone guy.
This relates to the Economic Bill of Rights and those that have been incarcerated and that growing number that has not been addressed in anything we've said. So can you comment on how you're going to give those citizens ability to participate in the system and get economic justice? Those people have served and a constantly growing number.
You want me to get it? I mean, the right to a job would be extended to those individuals that are formerly incarcerated. So they literally would have a right to a job. Going with a frame of rights literally is an entitlement that doesn't exclude those people that have been incarcerated. You mentioned at lunch, which I think is crucial, is that they shouldn't be disenfranchised either, right? So if we're really moving to a frame of an inclusive America, if you serve your time, you absolutely should have full restorative rights to vote and participate in a democracy. So I think that I'll even tie back into Sandy's point about reparations. One of the things that reparations does is there's the acknowledgement. There's the acknowledgement of how we got here, and that's a big component of reparations in addition to the redress. The acknowledgement allows us to get away from these frames. Part of these whole notions about disciplining the poor is very tied into our concept of race. If we could have an accurate, honest discussion in America about inequality and racial disparity, perhaps a lot of those tropes would be put to rest, and including the use of formerly incarcerated individuals to accelerate notions of who's deserving and who's not deserving.
Okay. Thanks a lot to all the panelists. I give to